April 18th, year 2023. This is Mijanur Rahman. Let's dig into our Excel sheet. These are the disclaimers. The copyright of this video belongs to myself, the accounting problem and solution as well. We have this company called Brown Inc. and it produces decorative chocolates. Mr. Munib, the general manager, is very upset with the company's profit and performance. Mr. Boldex, the accountant, was asked to perform an analysis with respect to variable and absorption costing. Brown Inc. expects the budgeted costs to be same in year 2024 and 2025. On the screen, you can see highlighted in yellow, dark yellow, after the green color, information with respect to year 24 and 25. So we are given budgeted units right there. It is 90,000 units right there. You can see that where the cursor is. And budgeted manufacturing cost, 600,000. Budgeted variable manufacturing costs, budgeted operating cost, 190,000. Budgeted variable operating costs, 200,000. And selling price is $100 per unit. And the inventory for 2024 is 3,000 beginning inventory. Unit sold was 87,000 and unit produced was 89,000. Year 2025 beginning inventory 5,000. Actual unit produced was 92,000 and unit sold was 95,000. Okay, it's a good idea to have your information structured this way. Okay, and then once that is done, we weren't given this information right here. Okay, we populated this information, so perhaps we can I can show you one right here in 2024, so you could figure it out the rest. Okay, so we have 600,000 divided by 90,000. That would give us 6.67%. We have 900,000 with respect to variable manufacturing costs divided by 90,000. That would give us $10 per unit. And then we would have this budgeted fixed operating costs. So we would divide 190 divided by this 87,000. The budgeted operating costs usually based on the units sold, okay, right there. And the budgeted variable operating costs, the same way, you divide that by 87,000 units sold with respect to 2024. These two number in our example is the same. It didn't change, but with if the information was different for 2025, then this number may not be exact. Okay, we divided 190,000 divided by 95,000. That gave us $2 right over here. I'm going to highlight the cells. You can see that in yellow. Okay, perhaps I can change that to Kion. Okay, and the next one is you divide 200,000 divided by 95,000, that would give us 2.11 cents, highlighted in green. I'll change that to magenta in a second, right there. Okay. This, when you see budgeted, the manufacturing costs are divided by the budgeted units, both the fixed manufacturing costs and variable manufacturing costs, always divided by the budgeted units. And that's why I put some notes here. You can see that right there. Okay. I'm going to highlight that in magenta. Okay. You can see the notes. I'm going to unhighlight this right there. And with respect to budgeted operating costs right there, highlighted in magenta again, those are with respect to quantity sold. Okay, the quantity sold is right there. I'm going to highlight that in red. Okay, based on that. So you divide 190 with the amount sold in each year. Okay. We already calculated this standard costing in a step one. Um, this step one could apply for both the, but I want to show you in a certain way so you don't make mistake, because cost accounting often has error. The cost accounting often error prone, so you need to follow. You need to be very methodic and you need to follow steps. So how did you get $10? The variable costs under the variable method. So this is cost per unit, or maybe we could say cost of goods sold, unit cost. Okay, also known as we capitalized, capitalized. So this amount is capitalized. Okay. Okay. So now with respect to absorption costing, highlighted in Keon right here, it is slightly different. Okay. Highlighted in Keon, I'm going to change that highlights to in green. Highlighted in green, you take the variable costs of $10. You take variable cost of $10 plus you add this 667 right there. Okay, so 6.67, that would give you $16.67. So the absorption costings takes the variable costs plus the fixed variable manufacturing costs and fixed manufacturing costs. Okay, variable manufacturing costs and fixed manufacturing costs. Okay, so the variable plus fixed, that would give you $16.67. In a step two, we calculate volume variances because you're going to need that for absorption costing. And why would you need that? Because at some point you will see that the unit sold and unit produced are different, highlighted in yellow. Okay, and you need to address that with respect to budgeted units, right? We budgeted for 90,000. We produced 89,000. I'm going to highlight that in Keon. You see that? we budgeted 90,000, but we produced 92,000 highlighted in orange. Okay. We are going to reset these colors. In a step 2, we know we'd have to get to find the volume variances. We would need to use our applied method, the applied cost and budgeted cost. The applied cost is that the actual quantity produced multiplied by this 16.67 highlighted in blue. Okay, that is our applied. Okay, I'm going to highlight that in blue. Okay, these are our, how we get that? We multiply 89,000 multiplied by 16.67. Okay, that would give us our applied costs. Now we move to budgeted cost, which we know standard quantity multiplied by the standard price. Our standard quantity was 90,000 right here, and our standard price is right there. And I'm going to also highlight these cells over there we're going to highlight that in our very favorite color, peach. It's not too bright, so let's highlight that in this color, orange. Okay, we're going to compare these two highlighted cells in Kaon. We're going to subtract between these two cells. Okay, we just simply subtract from left to right. So we have a favorable variable volume variance, and this is underapplied. And why? The moment you see the problem, you would know it's underapplied. How do you know that? Because we budgeted for 90,000, you produce 1,000 units less. Okay, again, I could show that to you here. Okay, 89,000 minus 90,000, 1,000 short. That's how you know it's underapplied. Because it is underapplied, we have less costs. Now let's go to our sales account. Okay, the absorption costing method uses the financial statements that is used by the external users. Okay, so you're gonna get our sales figure. We sold. I'm going to hide these cells over here so we can easily get our required information. Okay, hydros. How many units how many the number of units we sold is 90,000. It's actually 87,000 multiplied by the sales price, which is $100 right there. Okay, that is our sales. Okay, in second line you can see sales minus cost of goods sold. With absorption costing, we first find out the unadjusted cost of goods sold. And how do you do that? We multiply the unit cost under the absorption method multiply by the unit sold right there. So we multiply 87,000 multiply by the unit sold. We're going to unhide these rows over here because you need the volume variance, because we have underapplied volume variance. We're going to reverse the polarity at all time. You reverse the polarity, okay? Whatever you see there, it's a simple trick. You just reverse the polarity, okay? And that would, and then over here, you sum this to number. That would give you the adjusted cost of goods sold. You'd also need to reverse the polarity because it's an expense, right? To find out gross margin, we simply subtract the cost of goods sold from the sales amount, or we could just simply find out this way. Okay, so now I think this is better. It's less error prone. So now we find out the selling and admin expense. Now these are based on the quantity sold, okay? Our fixed cost wouldn't change. So we would put exactly the same amount, 190,000. And the variable costs, um, sometimes it could change. So we sold 80,000, 87,000 units, multiply by this 230. That would be exactly the same, which is 200,000. Right there, okay? This to sell. The fixed operating costs rarely changes. Even if it does, you would have to adjust it back to the budgeted amount. Okay, there was a problem that I come across where the fixed operating costs changed to a higher number, so we had to reduce it back to the original budgeted amount. With variable operating costs, it could be variable, but it would it would be limited to the it would also be limited to this number, the because most likely you'd be given one of this number. So if you're given this 230, then you would not be given this. If you're giving 200,000, you would not be given this. Okay, you'd have to calculate the standard costing. Okay, now we're going to sum this up over here. We're going to reverse the polarity. Sum this fixed cost. That would give us 390,000. We simply subtract the total operating costs, also known as selling and admin expense, $7,233,333.33. So you're gonna sum this up. It's a good idea to start summation from the lower row or lower column. Okay, that the same way. We're going to also do the same thing here too as well. It's easier. We have calculated our volume variances over here in this time. This time we calculated the volume variances on the other side, right there. Okay, and how did you get that? We simply divided the actual quantity produced, 92,000. I'm going to show you the cell reference, multiply by 16.67. So we are working on this, and this row over here, okay, highlighted in Kion. Okay. Now we're going to move to budgeted cost. We'll find out this, which is the unit cost under the absorption method, 16.67 multiplied by the budgeted units, 90,000. So we are working on this, and this cell. I'm going to highlight that in Kion. Okay. Here we just simply subtract from left to right. And you can see this number is positive. That means we over applied. And how do you know we over applied? Right here. Remember, we targeted for 90,000, but we produced 92,000. So we produced 2,000 units extra. And this is how you know we over applied. We overworked. Think of this way. We pressured our employees or labor or the plant to produce more. Okay. So this is how you know, by looking at the quantity, over applied or under applied. So now the sales amount would be different. How? Because we sold 95,000 multiply by selling price $100. I apologize. 95,000 multiply 100, that would give you 9,500,000 highlighted in magenta. These are the cells that we're working with. I'm going to highlight that in magenta for you. This, and this highlighted in magenta. You can see that, right? So now we're going to find out our cost of goods sold. And how do you find out? Remember, the absorption method looks at the sale minus the cost of goods sold. That would give us the gross margin minus the selling and admin expenses or operating costs. That would give us our income. To find out our adjusted cost, to find out our cost of goods sold, we would have to structure this. I'm going to highlight that this cell in pitch, or what color is it? We call it light orange. And this light orange, okay. So we will highlight, we'll kind of shade these cells off into, so you'll be able to see that, okay. So now we're working on the cost of goods sold right there. The unadjusted cost of goods sold is 16.67 multiplied by, you know our number, 95,000. That's the unit we sold. The volume variances, we over applied, therefore we are going to subtract this. Okay. And the row below, right there, we're gonna we're going to we're going to sum this up with the reverse polarity. But let's sum it up first. That would give us 1,550,000. We also need to, because it's an expense, we want to reverse the polarity to negative to show that this is an expense. This money came in, money came in, cash in, maybe I could say cash in and cash out. Not necessarily, but this is just to give you an example. This is a concept, okay? Then we go to our gross margin right here. I'm going to highlight these cells in yellow. We sum this up. We do bottom-up approach, and that would give us 7,950,000. We're going to reset these colors. Okay. Now, with respect to fixed cost, we are given, we sold 95,000 units. We don't need to do that. We could just simply say the fixed operating cost is 190,000 right there. And the variable costs is right here. $200,000. You could, you could multiply by this 211, multiply by units sold. Units sold was 95,000. And that would give us 200,000, right? Here we sum this up with the reverse polarity because this is an expense. And that gave us the total operating expense or selling and admin expense. To arrive at income, we simply subtract 390,000 from 7,950,000. That would give us an income of 7,560,000. Okay, that is our income. Okay. We can put this color back so you can see that. Okay, and we're going to also put this back to care color. Okay, and this is black cell, black color, black ink. Perhaps you can put them in a different, maybe some in a red color. No, not red color. Red color is very confusing. Very bad idea. Okay, and so this is our absorption income statement. Okay, I'm gonna make that cell a little bigger. Okay, like that, right there. Now we already have, before we move to that, I want to show you the cost released, and cost absorbed. And this is based on these cells over here, okay? Highlighted in in green. Perhaps you can change that to yellow. Highlighted in yellow. The cost released is that comes from the beginning inventory, and cost absorbed from the ending inventory. The variable method we are going to show you in about a few seconds does not deal with cost released and cost absorbed. Okay. To understand the cost released and absorbed cost, you could see my other video, the company called Hanshi Inc. I think. Um, I will upload that video later on so you can take a look at it. Okay, right there, we are working with this. So the beginning, I'm going to show you this number over here. How did you get that? This 3,000 multiplied by the standard unit cost. That is the cost that we released in 2004. I'll say yet 2024 cost released and absorbed. So cost absorbed simply means that the fixed cost that we did not use it with respect to 5,000 units that we couldn't sell, we forward that to the next year. Okay, so that's what it means. And I can just simply change that to a negative sign over here. So in year one, if we sum this up, that would, we have $33,000 that total. We actually, perhaps we shouldn't, but it's just a total sale. But with respect to year 2025, I'm going to show you over here. These are the same thing over here, okay? I'm just showing you as a duplicate, right? That's all. So you know how it came. We have the beginning inventory. Now we're going to release that. And you would have our ending inventory, which we'd have to figure this out. We had 5,000 units at the beginning. We produced 92,000. We add that. And then we sold 95,000. And that would probably give us around 2,000, if I'm not, that is 2,000. Multiply by this cost of the unit cost under the absorption method. That is, you can see that right there. I'm going to format this cell so you could okay, you sum this up. Okay, this is the these are the final number right there. Okay, the same thing that you can see and highlighted in yellow. Okay, now we're going to move to we're going to block all this off. All the absorption absorption costing method. I'm going to block or hide this because we are not going to work with this now. Okay, I'm going to also, so this is our variable method. The variable method works. The variable financial statement is for the manager to use for their day-to-day decision making purpose. So sales less the variable expense, that would give you contribution margin, less the fixed expense. Once again, sales subtract variable expense would give you contribution margin. From contribution margin, you would subtract the fixed costs, that would give you the income. Okay, so let's work towards it. Right there on the screen you can see. So let's find out our sales amount. In year one, we sold 87,000 and we multiply by 100. We are going to now move to manufacturing costs. We're going to multiply that with 87,000, multiply by this variable method costing 10. That would give us 870,000. And then we would have operating costs right there. The operating costs is, the variable operating cost is 200,000. We're going to put that in right there. We're going to sum this up. We're going to change the polarity on that. And then we would subtract, that would give us the total variable expense. We would subtract the total variable expense from the sales. So that is our contribution margin. And what we do now at this stage, we move to manufacturing, the fixed cost. We find out our contribution margin. Now we'd have to find out about total fixed costs. And the total fixed cost is again, the variable method dump in all the costs, right? So you're going to put that, the fixed costs, how much we have. So we have fixed cost is 600,000. We're going to put that in there. Okay. And the operating costs that we have is right here, which is equal, which is the 190,000 right there. Okay. And we're going to sum this up. Sum this. And we're going to reverse the polarity. That would give us the total fixed expense. Expenses are always in negative in the financial statements. You will see it in a bracket, okay, often. So it would be more often than not, okay. So now we're going to subtract the total fixed costs from the contribution margin, and we're going to do bottom-up approach right there. And then, so this is our 2024 income, which is the highlighted in green cell, okay? 6,840,000. We're going to move to year 2025. Very simple. We would multiply units sold, 95,000, multiply by the selling price budgeted, right there. That is our sales figure. Now we're going to move to manufacturing costs. And how do you find out the manufacturing cost? So the variable manufacturing costs, to find out the variable manufacturing costs, you would multiply the units sold. Variable, remember, this method only differentiates with respect to fixed costs. Okay, the variable costs are calculated in the same manner. Okay, so now we're going to multiply this 95,000 multiply by the manufacturing costs, which is the variable right there in $10. We also found it here as well. You can see that right there. You could take this cell or you could take this cell, whichever you like. Okay, same. So that gave us 950,000, and we would have our operating expense. It is most likely going to be, because it is variable, I can show it to you. So you could just simply multiply 950,000, sorry, 95,000 units, multiply by this 211, that would give you 200,000, right? But why doing all this work? We could just simply put it over there, okay? But it's a good idea to show that. So I'm going to show you that, and I'm going to also show this one here as well, okay? I'm going to show this here, 87,000. Don't get confused. Multiply by 230. That'll give you 200,000. Okay. Now let's move to. I'm going to actually hide this with with uh, with the white color, so you cannot see. Okay. So now you don't get confused. Okay. How do you find this 950,000? We simply multiply units sold, multiply the variable unit cost. That's $10. 95,000 times 10, that give you 950,000 in manufacturing costs with respect to variable expense. With respect to variable operating expense, you would multiply 95,000 with 211 right there, which the 211 is our standard costing that we find out earlier, okay? This 2,000, I'm going to show that to you again so you don't forget. 2,000 divided by this 95,000, that's 211, okay? Now we're going to sum this up over here. It is an expense, so you're going to reverse the polarity. So this is our total variable expense, 1,150,000. To arrive at contribution margin, we simply subtract 1,150,000 from 9.5 million, okay? So we simply subtract variable expense from sales. How do we do that? We just simply sum this up. Excel would do the work for us, okay? And then we find out our contribution margin, which is 8,350,000. We're going to move to manufacturing costs, which is, what is our manufacturing costs? Remember, the absorption and variable costing method are the only difference with respect to fixed costs. Okay, so keep in mind the variable method dump in all the fixed cost. Okay, so we could just simply dump in the fixed cost here. What is our fixed cost? And we're finding out with respect to manufacturing. So the manufacturing fixed cost, we have 600,000. We're gonna dump that in there. Okay. We can also find this out. How do you find out? But we don't need to go through that. Okay. But keep in mind, the only difference with respect to the fixed cost and no other cost, the allocation of the fixed cost is the key issue here. Nothing else. All else calculations, all the other calculations are exactly same except for the fixed cost. Okay. Now we're gonna move to operating fixed cost. We can also do the same thing. Our operating fixed costs were given in with respect to 200,000. We're gonna put that in. Okay. And we're gonna sum this up over here with the reverse polarity. And that would give us, oops, okay, that is 800,000. That is our total fixed cost. We just simply subtract fixed costs from the contribution margin. Again, the total fixed costs from the contribution margin would subtract contribution margin and total fixed cost column. That would give us our income. Okay, so you can see that. I'm going to put the color back to black so you can compare. I'm going to also unhide these cells over here. So step one is prior to step one, we find out the standard costing. In step one, we capitalize our cost of goods sold with respect to per unit. In step two, we find out the volume variances. In step three, we do an absorption costing. It's easier to do. And then we move to variable method costing in step four.